Last week, Planet Labs hosted an Investor Day presentation. Let's go over a few of the key highlights, including when we can expect some new satellites to be launching, Planet Labs' pricing guide, and of course, as you can judge by the name of the video, we're going to go heavy into the guidance and what kind of implications that might have on the share price. Let's get into it. To kick things off, we finally got an update for when we can expect the Pelican Tech Demo number 1 to be launching. During the presentation, Will mentioned that the Pelican Tech Demo number 1, alongside 36 Super Doves, are in Vandenberg. I think the safe bet here is to assume that it's going to be launching on a Falcon 9, more specifically the Transporter 9 mission, which is scheduled for next month. Now that we have a bit of clarity as far as when the Pelican Tech Demo number 1 is launching, the next satellites that we can expect to be launching are the Pelican Tech Demo number 2, as well as 2 Tanagers and a fleet of 30 Pelicans. So moving forward, Planet Labs has finally revealed the pricing structure so the public is available to see this and kind of incorporate this into a model. And they also gave just the general guidance. So what we'll do here is we'll kind of skim over things, compare it to the past Investor Day presentations, and then see what kind of implications that might have on the share price throughout the quote-unquote long-term period. First things first, we have the 20% annual revenue growth, sustained 115% net dollar retention rate, and a reiterated adjusted EBITDA profitability by Q4 of full year 2025, the period ending January 31st of 2025. So the next set of metrics that we have guidance for, we have non-GAAP gross margin being 70 to 80% of revenue, non-GAAP research and development 16 to 19% of revenue, non-GAAP sales and marketing 24 to 27% of revenue, non-GAAP general and administrative 6 to 9% of revenue, adjusted EBITDA 25 to 35% of revenue, non-GAAP operating margin 15 to 30% of revenue, and CapEx is 5 to 8% of revenue. What I want to do is compare these to the past 2 Investor Days. We have the 2021, 2022, and 2023 Investor Day and their respective guidance. Important to notice that these values are all expressed as a percentage of revenue and are in non-GAAP. So you'll notice that all of these metrics are virtually reiterated across time. So while the revenue has been adjusted a few times now, the past 2 quarters to be specific, you'll notice that these metrics overall are kind of in line. And so far, Planet Labs has been tracking in a positive direction to meet these goals. So what we're going to do here is we're actually going to work a little bit backwards. We're going to look at the metrics as a percent of revenue, and then we're going to circle back, and then we're going to come to the revenue. The reason for that is because of the recent revisions to revenue. So we already went over the key performance indicator section and where the satellite section is. Next up, you have the revenue by geography and the revenue by customer. Next up, you have the income statement, the balance sheet, and the cash flow statement. Up top here, you'll notice there's a little green tab. This is when Planet Labs went public. You'll notice also there is a little red tick. That is the most recent quarter that we have information up till. All of the information that is past this red line, so all of the future data, is basically derived from the next section below, which is kind of like a formula / calculator section. So essentially what this section does is it's a bunch of formulas that are working together that take all the past data, the current guidance, and then it'll spit something out on what we can expect to happen next, assuming that everything goes to plan, of course. The next section that we have below that is the actual valuation section. So this is basically where the share price is derived from. Very simplified overview is it takes the past data from here, feeds it down below into the second section, calculates what comes next, and then finally feeds it down to the third section where it derives a share price. So let's bring this in a little bit closer, and then we'll scroll all the way to the right and kind of go line by line through this section. So this might be a little bit like, it looks kind of noisy here, but really it's simplified by color. So blue is the cost of goods sold, purple, research and development, sales and marketing being green, and then yellow being general and administrative. And these are all kind of in the same format, if you will. Up top here, you'll notice that this is the number that can be adjusted. And essentially what this number does is it is going to, let's just quickly look into it. So I'm going to bring this down just a tiny bit so you can also see the formulas as we do this. So essentially what happens here is this number, when it's adjusted, so it takes the previous percentage and it's going to reduce it by this percentage. To kind of say the same thing different, adjusting this number is ultimately going to adjust this number. Now this number should be matching this one, which is the long-term guidance from the Investor Day presentations. So if you are looking to adjust ultimately the cost of goods sold in this example as a percent of revenue, if you're looking to make this one higher or lower, what you're going to do is adjust this one. You'll notice that I made the note there. Adjust this number to match this. Now you might be wondering what these percentages in between are. This is the way that I have been calculating the stock-based compensation as a percentage of the cost of goods sold, for example. And you'll notice that this, like I said, it's formulaic. It's like the same pattern throughout. So this one here, if you think that the research and development as a percent of revenue needs to be adjusted so that it can be higher or lower, you're going to adjust this number here, which will ultimately affect this number here, and it might fall in line or out of line with this number here. Let's just do a quick example. If you think that this one is not going to be adjusted by 3.5% each quarter, let's say you want it to be 4%. You notice that that's going to change everything in between, and ultimately we're going to land on 16.61% as a percent of revenue for non-GAAP research and development. I'm just going to undo that quick so you can see back and forth. So going from 3.5% to the 4% ultimately lands as a percent of revenue, going between 19% and the 16.6%. Now, the ones in between, this number is a percentage change for the amount of stock-based compensation. It's a bit of a crass way to look at things, but ultimately this number here is the forward expected amount of stock-based compensation. So you notice that over time, it's decreasing quarter by quarter. So that takes away the gross margin, because indirectly that's going to be your cost of goods sold. Research and development, sales and marketing, general and administrative. We've just gone through all of those. Next up is the adjusted EBITDA. So if you have all of these numbers and you're feeding it up into the section above, this is where the adjusted EBITDA as a percentage of revenue, you'll notice that the numbers that are down below and then fed back up, they're a little bit higher. So there are a few adjustments that might be able to be made. For example, the income tax provision is very low. This will probably need to be adjusted over time, but in the early stages of when they are profitable, they can defer the losses that they've had for so many years and kind of claim that going forward. Ultimately, this number is going to be a lot higher as a percentage, but for that initial period of when they become profitable, it won't be too noticeable. So the next number that we have guided for is the non-GAAP operating margin. You can scroll down below again to see that one, and this one is falling right in line with what was guided for. Finally, we have the CapEx, which is between 5 and 8%. You'll notice that that is a section within the cash flow statement section. So last but not least, let's talk about the revenue that was guided for. Planet Labs is claiming a 20% annual revenue growth rate. This year, we're going to land somewhere in the 15% range. These next two quarters are more or less guided for, and then this number here is ultimately just the full year expected revenue growth, year over year. So one more touch point that we do have that kind of pertains to revenue growth is there was a recent interview, I think it was the beginning of October, that Will Marshall was on, it's the Manifest Space podcast. He mentioned that in their pipeline, they have 70 seven-figure contracts and 5 8-figure contracts. So the math on that is 70 million plus 50 million, so 120 million total. This full year of revenue that we're expecting is about 220 million. So if Planet Labs was to keep all of the revenue from this year, all the customers, the contracts, and bring those into the next year, and also land every single one of these pipeline deals, that would put them at a revenue rate of 340 million, which would be a 55% increase. I realize that's not like that's by no means an assumption. Like, of course, they're not going to land every single deal. They're not a perfect machine, but it does kind of give a bit of an indicator as, I guess, potential. Even if they land half of those, they're going to hit that target as for the next year, anyways, the 20% revenue growth. But like I mentioned, layers and layers of conservation. So for this particular model, we just have the 12%. Because I felt like that was kind of a happy medium as for what's going forward. I mean, we're dropping from 56%, 42%, 31%, 11%, 11%, 10%. It's kind of seems to be going down, but I am quite bullish as far as like the carbon mapping, for example. I think that's going to be an incredibly important product for Planet Labs. It's just a matter of getting the satellite buses kind of approved and in orbit, but a little unclear on the schedule for that exactly. I think they're coming next year, but I don't think it's the worst idea to anticipate delays, just again, sake of conservation. So if we were to put all of that together, we can now, I'll zoom out a little bit so you can get a better overview. We have all of these, the 12% revenue. We have these metrics that are all matching guidance from the Investor Day presentation. We can now look at the earnings growth and the free cash flow growth. Now, these look ridiculously good, but keep in mind that these are very optimistic. You can see like way back here, I think that hitting like a 20% earnings growth, because I mean, if revenue is hitting 20% growth and the company is also trimming the fat internally, I think it's safe to assume that you're going to hit like 22, 23, maybe even 25% earnings and free cash flow growth. But that's only assuming that the company continues to grow at this 20% revenue rate while also becoming a more effective machine, which I think they will be. But I'm also rightfully hesitant in being a little bit too optimistic on Planet's guidance. No offense. So all this to say is the earnings growth expectations and the free cash flow growth expectation, these have been entered manually. And the reason for that is obviously if you were to just take the sum of all of the forward expected growth, you're going to have outliers like this one where it's like 10,000% growth. The reason for that is just the way the numbers work. If you're going from 11,000 for net income and then suddenly you're at, because when they go from negative to positive, there's going to be that period where it's like virtually no net income and then like a huge amount of huge in relation to the original value. You'll see what I mean here. It's like 11,000 and it goes up to 12 million. I mean, that's a massive increase. And obviously that's not sustainable. So you could go in here and collect the average of these, but then exclude any of the outliers like this 10,000. But you're still going to have like an unusually high number here. We're just going to go with 25%. And as you can see down at the bottom, if you put this all together, using the 3 share price formulas that I use, one's based on the price to earnings growth, one's based on the overall growth of the company. So it's like the revenue, the net income, book value, and operating cash flow. And then finally the payback price, which is more based on free cash flow. You notice that these values here, these are being fed from above as well. The 25%, they're coming from here, being fed in. And then the 18% is a manual entry. All of these are roughly in we'll call it the $8 range. So it's 260% increase in share price from now till January of 2030. This is all under the assumption of the 12% revenue growth. So this is where the spreadsheet becomes very malleable, is if you were to just simply say, I don't agree with the revenue expectations, okay, change it. Go up there, all you need to do is just take this cell, go from 12% to 20%, and you can see down below what kind of impact that's going to have on the share price. Going from the 12% revenue growth to the 20% lands us about 11.5. You could probably argue that this number here is going to be a little bit higher. We're not even going to bother changing that, but it does put the share price around the 11.5 mark, or a 400% increase, give or take. Now, of course, none of this is financial advice. This is just the model, the spreadsheet, the valuation. It's all just a series of formulas that are working together to ultimately put out one single number, being the share price. For the sake of curiosity, let's say that Planet really blows us out of the water. Let's say they hit like 35% growth from now till the end of the decade. Let's see what the share price might look like. Yeah, so we have 21.5 or a market cap of about $7 billion. So, I mean, that's like super bull case. Is 12% appropriate? 20% appropriate? Is something higher maybe? Let me know in the comments below, or if you're more the curious type, the spreadsheet is available via Patreon in the description below. Thank you guys for hanging out. I'll see you in the next one. Have an awesome day. Cheers.